I just really felt like there had to be a better way for real estate entrepreneurs and investors to be able to grow and scale their business without having to give up ownership. And so really like that is sort of where like the drive and passion for me came to build Nectar. Like I want to enable and empower investors to be able to grow and scale their business without having to give up ownership.
Welcome to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association, providing benefits and services to real estate investors and rental property owners for over 48 years. With your host, Brian Hamrick from Hamrick Investment Group.
This episode is sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com. And RCB and Associates, helping real estate investors and small business owners navigate the complex world of health insurance and Medicare benefits at rcbassociatesllc.com. Hello and welcome to episode 381. I have two incredible guests with me today to talk about financial planning for your short-term rentals, as well as the current lending environment and how to set up your short-term rental capital stack. Brittany Mosely is an Airbnb superhost who has owned and operated more than 20 units across the United States. And she's also an asset manager for a 100-plus unit co-living portfolio and a rental arbitrager. Derrick Barker has built a 4,700 unit real estate portfolio worth over $400 million. Both Derrick and Brittany uniquely understand the needs and opportunities of other real estate investors, especially those in the short-term rental space. Together, they're the co-founders of Nectar, the Cashflow-Based financing platform for experienced short-term rental owners and managers. Brittany and Derrick, welcome to the show.
Thanks
for having us.
We're excited to be here.
Brittany, why don't you tell us a little bit about yourself and your background and how you ended up getting into the short-term rental space?
Derrick and I went to college together, worked on a couple ventures while we were in school together, left college, and I actually went on to run a $125 million retail brand at Abercrombie & Fitch, left Abercrombie in about 2016. And that's when I moved down to Atlanta, and Derrick and I teamed up again. And I kind of took over all of like our, what we call like our smaller portfolio projects, which was really anything 50 units or less. So think single family, small, multifamily. But then I also built out our entire short-term rental portfolio. So built it out to about 125 units. By far, one of the hardest things that I've ever done, because getting calls in the middle of the night and on the weekends when guests need something, have forgotten something, have locked themselves out. Those are all the fun things that I had to deal with. So really, I mean, for us, like as we were like evaluating our portfolio and trying to identify other key areas of opportunity, like kind of just fell into short-term rentals. And we started out in our own apartment complexes that we own to kind of test the waters to see how it actually worked. Like, would it make sense for us? So started pretty small. And once we saw the return and like the opportunity that was there, decided to really scale it up into a 125 unit portfolio.
When you say we, are you talking about you and Derrick, or are there other people on your team?
Derrick and I, but like I pretty much owned the short-term rental side, but Derrick would be like my muscle man.
He's using the word we very loosely. It's like Brittany ran it and I showed up to help when it was an issue. I helped move the furniture.
Yeah, like putting together furniture, or like if we ever had like a serious issue with a guest and I like needed somebody to kind of come for reinforcements, Derrick would sort of jump in.
Derrick, let's go over to you. I want to get a sense of your background, but first help us track, like you and Brittany, how did you guys meet and what connected you?
Well, we were in the same freshman dorm, our freshman year at Harvard. And what connected us was, I don't know, a bunch of things, but we ended up dating and getting married. So that was one thing that has kept us connected. And we started several organizations like that. So I've been an entrepreneur from the beginning. So I had started multiple organizations. One got really successful my freshman year. I had a career on Wall Street. So while Brittany was, in the building and then running retail businesses, I was on Wall Street as a trader at Goldman Sachs. But we had we both had an entrepreneurial thing going. So for our wedding, for instance, we started like a electronics import export business that ended up paying for our wedding, and making a good amount then. And we just were good at working together. We complement each other. And so I had a big real estate business. I started buying properties when I was a senior in college. Build a portfolio through my days on Wall Street. When I left Goldman, I had about 500 units here in Atlanta, mostly multifamily. And so build a business flipping apartment complexes. Really started the neighborhood I grew up in, which is really hard hit by the financial crisis. There's a lot of blighted apartments. It was really easy. Go back. Nobody else wanted these apartments. I went and would buy them, make them the nicest apartments in the block. And yeah, we were at one point in the business, my real estate business was growing, and there were just nobody. I couldn't afford to hire anybody as talented as Brittany, but she decided to join the team and really took our business to another level. So we really complement each other well, the way that we work and then kind of our skill sets.
It strikes me that you're both uber entrepreneurial, startup type entrepreneurs and investors. So what a great coincidence that you both met on your freshman dorm to expand upon that. But you said something there that I have to dig into, which is you started an electronics import-export company to finance your wedding. What's that all about?
We have a big family and we wanted a big wedding. We had a lot of friends. So we had wanted a 350 person wedding. And we were well, and even though I was at Goldman at the time, making pretty good money, and she was crushing it at Abercrombie and Fitch and making pretty good money, but our sights were set a little bit higher. And then I was, buying all this real estate, so didn't have much in savings liquid. But I did, for one of my apartment deals, I bought at auction, a bunch of flooring. For $40,000, I got a whole apartment complex worth of flooring, LVP, electrical vinyl flooring. And the company also just sold a bunch of other stuff, including electronics. And so we just came up with the idea of buying just truckloads of old iPhones and tablets and then selling them. And Brittany was she was a much better salesperson. She'd be up at 1 o'clock meeting sketchy people from third world countries to sell dozens of electronics in sub-Saharan Africa and the Caribbean and all that stuff. Yeah, it was super profitable.
Probably not the safest thing as we look back. Yeah, get the bill paid for our wedding.
It seems like the startup, the tech part is part of your DNA for both of you. I guess the topic of the show is that capital stack for short-term rentals. And so let's go there. So you guys both saw a problem or a challenge for short-term rental investors. What was that challenge that led you to start up Nectar?
The reason that I was so passionate about starting Nectar was I had worked on my very first larger deal. And it was a 13-unit townhome complex right here in Atlanta. And we had to raise money from LPs or limited partners in order to get the deal done. And so investors are great because they gave us the money in order to be able to do this bigger deal. And I was the one that was on the front lines every day doing all of the work. So the construction management, working with our property manager to make sure that everything was running smoothly, doing all of the asset management, reporting out to investors constantly. And so I was truly the one on the front lines doing all of the work, which I very much enjoyed, and it was amazing. And I learned so much. But then when we went to sell the property, and the amount of money that I got was far smaller than the amount of my investors. And I just really felt like there had to be a better way for real estate entrepreneurs and investors to be able to grow and scale their business without having to give up ownership. And so really that is sort of where the drive and passion for me came to build Nectar. I want to enable and empower investors to be able to grow and scale their business without having to give up ownership.
Wow. So without having to raise money from investors, you through Nectar, you're trying to solve that challenge of coming up with the capital stack there.
Exactly. Within the capital stack, and Nectar, I would think of Nectar as your replacement for equity. Like that is really the problem that we're here to help solve.
I had a slightly different kind of thought. So why we would start at short-term rentals. I mean, ultimately, similar, like we were while Brittany was like selling this property, we were like buying another property, which is a much bigger apartment complex in LA. And we had a portfolio of cash flowing assets. And like short-term rentals, they make a ton of cash flow relative to the asset value, and they have low leverage. So, and we had apartments and single family properties, but we had a portfolio that was decently low leverage, making a ton of cash flow. But in order to come up with a down payment, we just didn't have the cash. We had like if we could just get our cash flow for a year and had it all today, we could come up with and buy the property. But that's when I was like, it didn't make sense to me that like no bank, there was no way that we could like get access to the cash flow we're generating. And that's why we started specifically on short-term rentals. So you can have some great operators out there, and we do short-term rentals, we do multifamily, we do single-family rentals. So we're not exclusive, but that's specifically where people are making huge margins. They have low leverage. And we want to, as Nectar, step in and fill that gap to provide the financing so that you can use and leverage the cash flow that you're generating in order to have the power to finish that renovation or furnish that next property or buy that next property without having to go and put together a deck and all this stuff and raise money to give up 70% of the upside to LPs. Love LPs, but there's like, for some things that are like less risky, we've already built a set cash flowing portfolio, you should be able to leverage that.
Let's take a step back and make sure we're laying the groundwork here for what capital stack is and the financial planning that goes into this. So Brittany, can you just explain to our audience, when we say capital stack, what are we talking about?
So when we say capital stack, we're basically talking about like the capital that you are going to use to acquire a property. So typically, like within that capital stack, I kind of like to think about it. I'm a visual person, so it's like a triangle. So at the bottom of the capital stack is typically a mortgage, like a traditional mortgage that you would get on a home. And then above that, you have to come up with the down payment. You have to bring your own equity or like your own money into the deal. And so either you can raise that money from an investor, and that's typically referred to as like limited partner or LP equity, or you can bring that cash yourself. Depending on the size of the deal and, your situation, sometimes it's hard to come up with that money yourself, which is why a lot of the people will tag investors to sort of help them bridge that gap. But that is sort of the way, I guess, you would think about the capital stack.
Traditionally, like the capital stack might have been 70-30, 70% of the capital stack would come from the lender, 30% would come from the investor or the LPs. Now that's sort of shifted because interest rates are so much higher. You're seeing more like 50, 60, 65% coming from the lender and then the rest coming from the investor. We mentioned in the intro just financial planning for short-term rentals, and I kind of want to address that as well before we get into some of the other topic here. But Derrick, what kind of financial planning needs to go into investing in short-term rentals? Firstly,
you'd have to, you have to like know what kind of like revenue you can drive, and then like, be thoughtful about the capital section you put together. So where are you going to get your debt? Where are you going to get your down payment? So and to make sure that you can, do the acquisition. When it comes down to it, like it's really about getting a really strong pro forma that you feel confident in, that you can take and put the debt and the equity together and feel comfortable like with the projections that you have in order to be able to service that debt and be able to generate the quality returns. We've actually, in our deals, we work with data providers like AirDNA or Rabu or Key Data, data providers like that to help us come up with where is actually the revenue and where's the demand for this property in this type of location. And we kind of use that to have a better idea of where does it make sense to invest. What we see with a lot of our operators is that people with really strong businesses who have like a specific business model, like I'm going to go after a specific target demographic. Like I'm going to go after all of the people who have, kids that are 7 and under in near this amusement park. Like a lot of people with these specific types of business models are able to outperform or outperform kind of what the general market. But until you have a business model that you can really lean on and a team that you can really lean on, in which case it's easier to use actuals and then project them that way. Yeah, data providers are a good way to use that. And then once you have a portfolio, our typical customers have properties already. So they have between 5 and 100 properties, and they have cash flow. And we allow you to look at the cash flow that you're generating and decide, hey, I'm making $100,000 a year off of this portfolio. Can I get an advance of $150,000 today so I can expand my portfolio and have more cash flow coming in without having to raise any additional outside capital or come out of pocket in any way?
I'd like to take a moment to tell you about Green Property Management. Not only do they manage everything from single-family homes to apartment complexes in the West Michigan area, they also manage my entire portfolio. So I can tell you from personal experience that their unique flat fee management style is worth a closer look. If you feel that your property isn't operating to its fullest potential, then Green Property Management can help you take a holistic approach that will save you money, eliminate your headaches, and increase your net income. And if you're a property manager interested in applying Green Property Management's model, give them a call at 1-866-95-GREEN or visit them on the web at greenpropertymgt.com. If you're thinking of leaving your W-2 job and becoming a full-time real estate investor, one of the greatest costs you must consider is healthcare for you and your family. When I made this transition myself, I found the whole healthcare insurance process to be confusing and frustrating. That's why I'm glad I met Chad Creasy at RCB & Associates. Chad is a professional health insurance agent who helps real estate investors and small business owners understand and choose their best healthcare options. And best of all, his services are covered by the insurance company and won't cost you a dime. If you live in Michigan and are expecting a change in your healthcare insurance coverage for any reason, or losing employer coverage or transitioning into Medicare, then you owe it to yourself to contact Chad Creasy at rcbassociatesllc.com. So you just kind of described what Nectar is doing. So let's talk about that. What brought you in that direction? Hey, we're not just going to invest in short-term rentals, but we're going to help fill that capital stack. And this is how we're going to do it. Take us through that thought process that brought you to Nectar.
Thought process was, if you have, especially being on Wall Street, you see capital can find opportunity, in markets, but in the real estate market, the way to raise capital is just pretty inefficient. It's either, what we see with the life cycle of a lot of the investors that we talk to. And now we work with hundreds of investors or real estate entrepreneurs. The life cycle is, first you start off with your own capital, maybe capital from close friends and family to do your first set of deals. And that gets you, your first year or two in business. Maybe you're selling those properties and turning it over to grow. Or refinancing in order to get capital to grow. But at some point, assuming that you're successful, even though your friends and family are super happy with what you do with your money, you reach a point where in order to continue to build your portfolio, either you have to always be selling properties and turning them over, which you can make higher IRRs, but that's a difficult way to build long-term wealth. Buying an asset and holding it and letting it ride. Buy something, fix it up, have to be really nice and low leverage and just letting it appreciate. It's a much easier way. But there aren't really capital options out there that are set up for that. People, once they finish with friends and family, they typically go LP equity and raising money from high net worth individuals or maybe even small institutions. And the way that these deals are set up is they're just set up to incentivize selling properties and turning it over and giving up ownership. So the idea for Nectar came about because we wanted to fix that problem. We wanted to give people who know how to run a real estate portfolio a tool that they can use where they can, if they want to, be able to keep more of their properties and not have to sell if they don't want to. We don't have a lump sum payment that you ever have to make. You're just paying out of cash flow. And if you have stable, consistent cash flow, which a lot of these real estate assets do, people with stable, consistent cash flow, they should be able to lever the stable, operations that they've built in order to have buying power to go and expand and, to build their portfolio and their wealth.
Brittany, can you take me through a specific example of like an investor who would leverage your platform?
So we typically, I would say, like our average customer or client has around 5 years of experience, either owning or operating real estate. And we want them to like actively own or manage a stabilized cash flowing like rental portfolio, whether that's short-term rental, multifamily, long-term, single family. We want them to be professional operators. So these are people that have a business entity in place. They have some sort of accounting system in place. And most often with the clients that we have, they have like an actual support team. So within the short-term rental space, they have, managers who are going in and managing like the actual operations day to day, or in the same thing, I guess, on the long-term rental side. Like typically people will have third-party managers. We also have clients that do the managing. So that's, I think, one unique thing about what we do is that like we work with people who own properties and then who also manage. And then we're looking for clients who are obviously cash flow positive because we are underwriting the actual cash flow that their portfolio is generating. And they have less than a 75% portfolio level LTV.
You're not bypassing the traditional lenders on this. So you're filling the capital stack on the equity side. And I'm trying to wrap my head around how you structure this. Like, are you in a second lien position? Are you coming in at close with that equity, or are you coming in later to help bolster the equity? I mean, walk me through a traditional closing process.
We have two products that are like slightly different, but they play the same role and they work really similarly. So, but to answer your second question first, we work with people where we come in at closing or before closing. We help people. A lot of our customers are, using us to finish a renovation. They've already closed. They've gotten to, they have, 5 properties. One of them is being renovated, over budget and, need additional capital to finish it off. And then, we come in and help there, or to buy another company. We can fund that closing or before closing because we're looking at the existing cash flow from your existing portfolio. One product is a cash flow assignment agreement. So we have no lien on your property, not first or second. It's an agreement with the property owning entity. So you have to have an LLC or some entity and we have a lien on the entity, just like a UCC financing statement. And that's kind of how it's structured. And there is a personal guarantee. So it's structured there's a assignment agreement with the entity, not with the property, and there's a personal guarantee. In the other product, there is no personal guarantee, and it also is not a loan at all. It's similar to pref equity in that we become a member via your operating agreement, a member of the LLC. You make the same payments. So we give you, say, $100,000. You pay us, $5,000 a month for the duration of the term. As you pay us off, you buy out our interest. So by your last payment, we're completely bought off. We don't get any upside. We don't get any, we don't have any voting rights or, say in how you use how you operate the business, but it allows us to sit in that role, in that part of the capital stack that's not debt, it's not mortgage. We're not interfering with your lender. We don't have to get an intercreditor agreement, but we're secured by either interest in your property or just a contract with your property on the entity and a personal guarantee.
So that is more like a traditional pref equity type arrangement, the second option you just said, where you're part of that capital stack, but you're more like an investor. You just have preferential treatment as that in that role. It's
similar, except for unlike most pref equity, there's no lump sum payment ever, and we don't get any upside. It's just you make the same monthly payment every month for a certain amount of months, say 1 to 5 years, and at the end of that 1 to 5 year term, we're completely bought out.
Often a property is purchased for short-term rental purposes that doesn't have a history. So you can project what the cash flow is going to be using AirDNA or some of the other platforms you mentioned, but you don't know because you don't have any real history to point to. How do you address that situation?
We work mostly and work best with people who have properties that are already existing. So most of our customers, if they're buying another Airbnb, they have 3 or 4 already. And we're looking at that performance on those properties, and we're giving them, in advance on those properties that they then take and use as a down payment on a new property that doesn't have any history.
So in a way, it's like a line of credit to some extent because you don't have to use it specifically on that property.
Right. There are no restrictions on how you use the capital, except for it has to be for a business purpose. But you can buy a property, you can buy a property management company, you can buy furniture, you can, we've had someone buy a boat because they had a property that was on a lake and they went to buy and rent the boat out also. So, it's super flexible.
Yeah, we've had people use it to like hire additional team members as they're growing and scaling, furnish like their next Airbnb. So as long as, like Derrick said, as long as it's a business related expense, the options are endless.
What is the formula you use then when you're looking at existing cash flow as to how much you're willing to lend?
So we look at how much net cash flow that you're generating. So we we'll look at a T12, or if you have a rent roll, because you have multifamily, you did a lease up and your lease up and your T12 isn't great, but you stabilize now and you have a rent roll. We'll look at that. We're looking at how much cash flow you're currently making on a monthly basis. And then we price ourselves so that you're paying us, max 50 or 65% of that monthly cash flow. And then we layer in our cost of capital. And then that's how we back into how much we can give you. So we're never going to give you so much where you're paying more than 50 or 60% of the cash flow that you're generating. We have an algorithm that, we put a bunch of pieces in and the algorithm spits out a score. It tells us what we can do. But that by and large is how I think about it. For back of the napkin numbers, I think we can probably get you 1.5 time, like plus or minus, let's see, we get you about 1.5 times the amount of cash flow you're making on an annual basis.
So if your annual cash flow is say $20,000, you could loan up to $30,000 that you would expect to be paid off over a 2-year period, 3-year period?
Up to 5 years. So we have 1 to 5 year terms. And the max amount, if you do the 5-year term, you'll get the most amount because you have, the most amount of months to pay back. And we're only going to make your monthly payments so high. That's the focus. We're really laser focused on how much can you pay every month. We can stretch it out over 60 months, or you can make it 12 months if you want, or 3 months. Mm-hmm. But, if you want the max amount of money, you probably would have to go with the max term.
And what's the ballpark interest rate that people would attribute to this?
So because it's not a loan per se, the way we calculate it is a financing fee. So we give you $100,000, we're going to charge you between, let's say, 12 and 15%, annually on that $100,000. So if $100,000 and you pay back in it's a 1-year term, you'll pay us, let's say, 112. It was lower at one point, but interest rates are pushing, and that is what it is. But if it's a 2-year period, you'll pay back 124. 3-year period, 136, if that makes sense. So annual financing fee, it is based off the term, how much you end up paying in total.
Brittany, you had said that you typically work with professionals, people who have a track record, have a portfolio, and you look for certain clues as to whether or not they meet those standards. But tell us what those clues are. What are you looking for when someone comes to you for this type of agreement?
So we're looking for somebody who has at least 3 years of experience, either owning or managing some sort of real estate. So whether it be single family, multifamily, storage, it doesn't matter. But we want to just make sure that you are seasoned and experienced and know how to actually run and operate a real estate business. We also are going to we want to just make sure that you're not going to be over levered. So we are going to look at the leverage within your entire portfolio and make sure that your leverage is less than 75%. And then I think one distinction that I want to make, because we are talking about cash flow, and the way that Nectar that we look at, or the way that we define cash flow is your revenue that your business is making minus your expenses. And your expenses include any sort of debt service you have. So any sort of like mortgage payments or any sort of debt that the business has. So when we're talking about cash flow, we're looking truly like at your bottom line, like after all expenses, including debt, are paid, how much money are you actually making? And so obviously, in order for us to be able to provide in advance, you have to have positive cash flow.
We'll strip out CapEx or one-time expenses.
Yeah. To Derrick's point, we do strip out any sort of like CapEx or one-time expenses. Like we're looking at like, what is your like reoccurring cash flow? So if you are a short-term rental operator and you spent like $30,000 setting up this unit, like we would strip that out. Or you had like a major CapEx issue, you had to replace your roof, that's something else that we would strip out. We're truly looking at like those ongoing and reoccurring expenses.
It sounds like, if I'm listening carefully, it's based on your portfolio and it's based on cash flow. So it's a portfolio and cash flow based type of loan that is paid out of cash flow. Is it a fixed monthly amount?
Yes. It is a fixed monthly amount, which we were very intentional about. Like typically with a normal investor relationship, your investor is going to participate on in the upside. So if you make, like even when we had like our Airbnb business, if we had a killer month where we made $10,000 and we were only projected to make $2,000, our investors were getting 70% of that $10,000 that we made. So they participated in the upside. With Nectar, if your monthly payment is $2,000, you're going to pay us back $2,000 every single month, no matter if you made $20,000 that month. We still get $2,000 and you get to keep that $18,000. That was something that was really important to us.
Caveats is we do have ramp up periods. And if you have a very cyclical portfolio, we can make the payments cyclical also, just to be more flexible around your business model.
Yeah, like if you're in a seasonal place like Michigan or I don't know, the Hamptons, we try to be flexible and work with the operator based on the construct of their portfolio.
Are you in all 50 states?
We are, yes.
What's your favorite hack or app? And Derrick, we'll start with you.
I really love Firefly's Note Taker. I'm one of those people who like, I have a ton of meetings. I guess at the end of the day, it's like, wow, what did I even do today? But like, it's like it's an AI tool. That's also my favorite use of AI. There's an AI tool that like listens to your calls, transcribes them, writes a summary of the meeting, and you can go back and read or listen to, and you can search for different phrases. So it's my favorite hack so that I'm not talking, trying to also write notes.
So the name of it was?
Fireflies.ai. It's also pretty cheap. It was like $10 a month when I got it. I don't know. The price might have gone up now, but.
Brittany, what's your favorite hacker app?
I would say like my most recent one has definitely been ChatGPT. As obviously we're constantly doing research and like building out content and marketing. And it's just been super helpful, I don't know, to use ChatGPT in order to come up with like the research so much faster than I would on my own using like a Google.
And then how would people find out more about you or find out more about Nectar?
Our website is usenectar.com. So please, and our website has a ton of information. The application, if you're interested in applying for funding, is right there at the bottom of the page. And so tons of information there. We also have like a resource library. So if you want to learn more just about like financing, like how to finance a real estate portfolio, how can you like leverage Nectar as you're trying to grow and scale? We have tons of resources on our website also.
And Nectar is spelled?
Nectar.
Is it only for short-term rentals or can it be used against anything else?
Any sort of real estate. So short-term rentals, long-term rentals, single family, multifamily, self-storage, any sort of real estate.
If it cash flows, it goes. So we're probably quickest at short-term rentals, multifamily, long-term rentals. But if it cash flows, and we'll take a look at it.
Brittany and Derrick, thanks for coming on the show. And talking about that capital stack, I thought we were talking about short-term rentals, but now it really is for any type of commercial property or property. The capital stack, kind of that analysis and the product that you both have come up with that helps fill that capital stack. It's been a really interesting conversation. Thanks for answering all my questions. It's been a real pleasure.
Thank you for having us.
Yeah, it's been an awesome conversation.
I want to thank everybody for listening to this episode. I'm your host, Brian Hamrick from Hamrick Investment Group, and you can find out more about me by going to higinvestor.com. That's higinvestor.com. And you can also ask questions and join us on Facebook by going to RPOA, Rental Property Owner and Real Estate Investor Podcast. This episode was sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com. And RCB and Associates, helping real estate investors and small business owners navigate the complex world of health insurance and Medicare benefits at rcbassociatesllc.com.
You've been listening to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association. You can find out more at rpoaonline.org. If you enjoyed this podcast, please go to iTunes to subscribe, rate, and review.